So welcome everyone. Welcome to this Market Thursday. It's October the 21st, 6 p.m. here in London. As always, a quick disclaimer. Please, those webinars are not investment advice. So this is purely for information. I do not take responsibility for losses incurred by viewers. So please do your own research before doing anything. So again, thank you for joining tonight. And for those of you who will be watching later on YouTube, thank you again. So let's go quickly through my background with my CV. I started to work in the industry in 2000 in Paris as a cash equity trader. Then I moved to London in 2004 when I joined Griffin Capital Management. Working first on the long-only product, then on the long-short product, mostly on Europe. We had exposure to Eastern Europe and a bit of exposure as well in the US. From 2009 to 2018, I was working for Infinity Capital Markets as a prop trader. Infinity Capital Markets is the UK branch of First New York Securities, which is located in New York. I stopped trading at the end of 2017, was a bit tired. Since 2014, I've been doing mentoring programs. I worked before for another company that I left in 2017. I restarted my own mentoring program in 2018 and launched a couple of years ago, the 4x4 video series, which helps retail traders or traders to get a professional investment process. So what are we going to be covering today? So today we're going to be talking about, as usual, the situation across asset classes, stocks, credit, commodities, and FX. Looking at a quick market review, that is something that I like to do, not only today, but that is something that we do during the mentoring sessions. Looking at different performances across asset classes. Then we're going to be looking at the recent moves on the Fed expectations and the central bank's expectations. So a bit of Fed, a bit of Bank of England, not ECB, but that's there has been a move as well on the ECB. It moved quite a lot. Then we're going to be looking at the earnings season that we mentioned a couple of weeks ago. A couple of weeks ago, we said that the market was waiting for this potential catalyst, which is the earnings season. Very often, at least for the last 4 quarters, the market reacted pretty well during this earnings season because companies have been beating expectations. Then we're going to be looking at the oil market every 3, 6 months, 12 months. This is something that I like to be discussing with you. WTI oil market, supply and demand. We know that oil is above $80. Question now is it too much or not? As always, very quickly looking at the catalyst going forward, we are literally in the middle of the earnings season. Next week is going to be very busy in the US, Tuesday, Wednesday, as we're going to be covering later. We're going to have a lot of earnings coming. We get the ECB next week. We get the Fed in a month's time about the tapering. So we have those clear catalysts for the earnings. And as we're going to be discussing first with the central bank expectation, there has been some interesting moves. In terms of asset classes performances year to date, so in blue, we get the stocks. Here, this is the big outlier, which is the Bitcoin. So for the Bitcoiners, well done to you. We are now trading at 65,000. We are making a all-time high. But I'm interested in the other asset classes with stocks mostly up between 15 and 20% for developed market. We had a bounce of 5% since we had the last webinar a couple of weeks ago. In terms of dollar versus currency, the picture is more or less the same. Year to date, it's outperforming the other currencies by 2 to 5%. Gold has been really struggling, as we discussed before. Is it a question of Bitcoin is the new safe haven? I don't want to go into that conversation. There are many people on YouTube who will be doing some dodgy talk about this, so not for me. And WTI up 73%. That was for the year to date. The week to date, very strong week since the start of the earnings season. So earnings season, as you probably know now, if you've been following those different webinars, is really starting with JP Morgan. JP Morgan kicked off the earnings season last Wednesday. The stock didn't react very well on the day, went from 164, 165 to 160, 161. But we knew that for the last year or so, JP Morgan has been reacting badly on the day of the earnings and then has been bouncing. Now it's at 170, but for the week-to-date performance, literally we had a 200 points move on the S&P from 4,300 to 4,550. Nasdaq has been doing this move of 4%. So very strong risk on, a bit less for Europe, only by 2%. But actually the euro has been strengthening a bit by 1%. So the underperformance is roughly by 1%, as we see here. So 0.5 to 1%. Bitcoin up 15%, and oil still very strong and up another 4%. So that was as of yesterday. For WTI, there's been a bit of weakness today. Maybe we're going to be covering this. In terms of the 11 sectors of the S&P, what we try to do as investors is trying to find the good sectors, the sectors that will outperform the market, and the sectors that might underperform the overall market. So this is for alpha generation, and we're looking at the 11 sectors of the S&P. Energy going hand in hand with the WTI is up 50% plus, followed by the financials, which have been helped by two things that we mentioned before, which is a better economy, so a GDP growth, and as well yields going higher. As yields are going higher, this is helping banks, which are lending at a higher yields, and especially if there is not a flattening, let me find my word again, if the yield curve, if the differential between the 10 and the 2 is widening, so a steepening of the yield curve. And week to date performance 4%, as you can see, for the S&P, and overall, except consumer staples, which is seen as defensive, everything has been up between 3 to 5%. So again, very strong market. This slide that I like very much, because that gives you a better understanding of what has been happening. Looking at the bonds, so bonds now, the US 10 years is almost at 1.7%, so 170 bips. Quite a big move. Recently, we went from 140 to 170. We are testing in terms of yields and close to the level that we had in March, to 175, 180. And those the sell-off in bonds, meaning yields going higher, has been across regions. So clearly, market participants are expecting inflation to be less transitory. So if you look at the picture, and the thing that we discussed since probably March onwards, it was all about, is this inflation transitory? And that has been an acceptation now that it's not. And actually, next topic that we're going to be discussing, we'll see how big that move has been. In terms of top winners, top losers, you decide which universe you want to be following. Here we are talking about roughly 1,800 stocks, depending on the performance. So we got stories like Pinterest, which apparently get an approach from PayPal. So this is special situation. You get Macy's, where we are talking about a potential, not spin-off, but looking at the different assets of the company. And on the other end of the spectrum, as always, you're going to have many biotechs, because, if your pillar works or not, that makes the stock moving by 20 or 50%. To me, what is interesting is the VIX. The VIX, which is for the implied volatility of the S&P 500. So now it's below the 16%. As you know, the rule of 16, that means the market is expecting less than 1% move on the S&P. The 15% level is, we don't do technical analysis on the VIX, but this is the kind of the support level that we had this year very often when the market is around the 15%. This is where we stop going lower in terms of implied volatility. That goes hand in hand, obviously, with the crash of the realized volatility. So what happened since we last spoke, especially from last week onwards, we had the option expiry last Friday, and a couple of days before, we started to have a crash in implied volatility. Stock going higher, volatility being crushed. And in the meantime, as the dealers started to go long gamma, they were chasing the futures. So you go from a market which is at a 20% plus implied volatility, that suddenly volatility is sold off. Market goes up. Market makers or dealers need to chase for their gamma, and you get a reset on the Friday, Monday. And then a couple of days ago or yesterday, we get the VIX expiry, where literally you got a lot of open position with a lot of put buyers, meaning literally the volatility was crushed. So a lot of functionality based on options. The market is very much driven by options still. Today is a very interesting day. Maybe look at, after this call, or if you are looking this weekend, looking at Tesla. So Tesla came with their earnings today. And interestingly, the cash a couple of hours ago was trading 15 million shares. And in the meantime, the options were trading roughly a notional of 100 million shares. So that tells you the frenzy that is still driven this market with options. So another one, as always, I try to put one or two charts on macro. So here we got the US housing, the new permits that came a couple of days ago, which came at 1,589,000, which is quite funny. I don't know if that is the word, but exactly the same number that we had a year ago. So it seems pretty much like the housing market is cooling, and as well that we are back to the seasonality, with meaning that September, October, November, December, this is the time when the numbers are not that bullish. So a bit of slowdown for the housing, something to carry on watching. Let's move into the technical analysis. Let's move into this that will be the one. So UPST, I just wanted to make the joke because, UPST, if you've been on social media, you've seen probably the story last Friday about this guy who struggled with knowing what was the company. And that's quite funny because this is a company that we covered during a call. I think it was in October or September. So those are the names that we are covering, but that is always a bit of embarrassing when you get those kind of questions. Sorry for the guy. At the end of the day, he's a momentum trader, but this is what has been happening. I want to start with the VIX as always. So VIX, here we are at 15.4. As you can see, for the year, those are the low level of the year. There is no technical analysis on the VIX again, but that tells you, at least for if you're trading with options, what is the implied volatility you are buying or selling for the S&P 500. If we jump now into the S&P 500, so last session a couple of weeks ago, I told you that we probably met some support. That was true for the Nasdaq that we're going to see later, and for the S&P. But I was expecting the market to be trading sideways, and not really the S&P challenging so quickly its all-time high. So now we are 2 weeks later, we are 10 points from the all-time high. Earnings season is pretty good. Seasonality, as we discussed over and over, if you don't know much about seasonality, you can look at the chart that we discussed a couple of weeks ago. Is pretty good for the equity market normally, November and December. Having said that, if you look at October last year, from now until the end of the month, there was a bit of a sell-off. We went from being very cautious, what about we sell the market, to now everyone telling you we're going to be making new highs and we're going to be going to 4,700. I think that requires a bit of cautiousness. I'm a bit cautious here. I have a bit of a short, so let's see how it goes. But this is for the S&P, for the Nasdaq composite. So this is the support that I mentioned. I tweeted that was 10 days ago, and literally we bounced nicely on it. We have not been making new highs. We are still 2% from the new highs. Everything will be driven by the big guys next week. We are talking about Apple, we are talking about Facebook, Microsoft. So we get some very big names coming next week, and obviously that will give us the color on the Nasdaq next move. If we look at the Russell, so the Russell picture is still the same. We are mid-range that we started at this year. No real change. A bit of Europe for the European followers and European traders. Similar picture. The thing is, the trend has been broken. And actually, if you go back to and that is something that I should have done before, if you look at the S&P, the trend that we started since November last year, since the election, since the vaccine, the Moderna, Pfizer vaccine, the trend has been broken. Okay, so it feels to me like very much maybe we're going to be testing it, but I think it's going to be very hard to come back into those trends again. I'm talking my book here, obviously, and you need to take a pinch of salt, because over the years I've been very often wrong with the S&P direction. So be careful. I'm better with stocks than I'm with the S&P. Next one, just want to be a bit of stocks, looking at Tesla, because Tesla is making the headlines. They came with their earnings and sales. So this is the Tesla picture. We are testing the 900 level. As I told you before, check the 900 call. There is still a frenzy. Strong price action. Let's see, volume today is going to be massive, and everyone is looking at it like a cup and an handle, which is, you get this consolidation, and then when it goes, it should go higher. The debate is still on. How much is it worth? It is going, and as long as it is going, the price is doing the talking. JP Morgan, because as always, I like to be checking JP as a market leader. This is the sell-off around the 160 that we had. And then we are back now to the all-time high. So this is, you get many stories, many stocks where the chart is going to be more or less the same. Apple is a bit far away from this all-time high, but something that I tweeted 10 days ago, around the 141, and we are at 148. On the other end of the spectrum, we get this IBM. So IBM, I've been covering IBM through mentoring sessions over and over. So that's the long-term chart. So let me give you a weekly chart. And you can see that as long as we have not been breaking this this flag, the way is down to the 105. Today the stock is down 10%. And interestingly, if you look at the fundamentals of IBM, there are so many bad things to say. And more importantly, something that we cover in the 4x4, which is your capacity of, with your free cash flow, to be paying the dividend and the debt, and the share buyback. Actually, IBM has been using debt to be doing both. So there is a leveraging of the balance sheet. So the core business is not doing very well. We know that the cloud business, they have been very late in the cloud business, but that is a chart and a story that is interesting for the time being on the short end. As long as they are not going to spinning off some businesses, which is the only risk that you have, it has to go down. A bit of NVIDIA, because it's always good to be talking about market leader. Let's go back into a daily chart. So daily chart, again, very similar chart as the S&P, as the JP Morgan, as everything. We are $5 from the all-time high. If we back the 230, here we go. It's going to go higher. I think the earnings are on the 11th of November. I'm not sure, but it's a bit later in the earnings season. A bit of yields, just the US 10 years, because we mentioned that before. So now we are at 168. We are not back to the levels that we had in March, but you can see that over the last month, the US 10 years is up 35 to 40 bips. So this is quite significant. The market so far, and I'm talking stocks have been digesting this information pretty well. Sorry, I can't hear you, Kevin, on UPST. I can't hear you. I can't tell you. So far we have been digesting pretty well the move in bonds. Next one, a bit of emerging market with the Turkish lira, something that has been pushed in the community since the 889 from one of our subscriber user. So today the Bank of Turkey changed the rates to 16%, and there has been a weakening of the Turkish lira. Again, be careful when you trade those currencies, because especially this one is going to be moving more than the others. Okay, now let's go back into the slides, and we are there. And we're going to be moving into the usual central bank's balance sheet, just for us to keep in mind that for the time being, central banks across the world are still very friendly, dovish. And as you can see, the Fed balance sheet is still growing from 1 month to another, exactly the same. There has not been any tapering. Tapering should be starting at the end of November, December. And for the ECB, the ECB is still very active. So you have still a ton of money, of liquidity going into the system, which is helping the risk on and the strength of the risk on. A bit of Fed expectations. So here, this is the euro dollar futures. If you don't know what are the euro dollar future, either you buy the 4x4 video series or you try to go through the different webinars. So that is something that I've been explaining over and over. So Here on the first table is on the 22nd of September 2021. And the second one at the bottom is from yesterday. And it tells you when the Fed is expected to be moving. So if we look at September 2022 first, a month ago, it was at 99.7 for the EDU2, and now it's trading at 99.53. So what does it tell you? Now the market is expecting the Fed to be hiking rates by 25 bips in September. If you look at June, where we get 99.69, that is a 50-50. So that is quite different from what we had from a month ago, where a month ago, the market was expecting in 2023. So this is the one, the 99.53. If you do that versus the 99.18, that gives you 27. Okay, and 27 means a 25 bips rate hike. Now we have in December 2022 versus the March 2022, 50 bips. So in other words, now the market participants are expecting the Fed to hike rates twice by 25 bips in 2022 versus only one time a month ago. Okay, and if we look at the start of the year, no expectation. Now, let's look at December 2023, 98.89. That was a month ago versus 98.58 now. So between now, which is, sorry if it's a bit confusing, but between now at 99.81 or 82 and 98 between 0.58, we got roughly 120 to 125 bips. So that tells you we, as market participants, expecting the Fed to be hiking rates between now and the end of December 2023 by 125 bips, or 1.25%. In other words, that tells you that we went from, oh, this is transitory, don't worry, there is no inflation. We are not expecting the Fed to do much. That was at the start of the year before 2023. Now we say 2022, we're going to do 50 bips and 125 bips in 2023, between now and 2023. So when we started the year in 2021, when I did the webinar, I told you that there was a great opportunity if you were thinking that inflation was coming, because the market was pricing nothing literally until end of 2023. And as you can see here, or we're going to go into the next slide, those things move quickly. So here, this is the EDZ2, which is the euro dollar December 22. Okay. So at the start of the month, we were at 99.50. So literally versus the 99.8, market was pricing 25 bips change, whereas now, as of yesterday, we are at 99.3. So you see this massive change where, in other words, that is not minus, that is plus 25 bips expectation in 20 days, okay, 20 days. In the meantime, what happened is the equity market is up 5%. Is the NASDAQ is up 5%. So normally what you will see in situation like this, when the market is expecting higher inflation and the central banks to be hiking rates, you could assume that stocks will be suffering. That has not been happening. So very much so, very strong market, equity market, despite the Fed expectations going higher. Here, this is the euro dollar, where in yellow we get the what happened. Where is the euro dollar curve? So this is from Bloomberg, and in blue this is the euro dollar curve that we had a month ago. As you can see, everything has been moving down for the euro dollar, meaning Fed expectations in terms of bips or hike have been higher. Similar here when we look at in yellow, that was as of yesterday, and in red, that was at the start of the year. So at the start of the year, when I did my webinar, I was looking and saying, you know, guys, this is the expectation from the Fed. We are expecting the Fed to do zip for the next couple of years. And I said, again, if you get the expectation that something is going to happen, this is, in terms of risk reward, a great risk reward. And guess what happened? This is the move that we had across the yield curve. So you can do that again. Monitor this euro dollar. You don't need a Bloomberg. You can go on investing.com and type in euro dollar, and they will give you the different contract, and then, you know, put it on an Excel spreadsheet. Here, this is for the Bank of England, because I live in the UK. I have followers in the UK, and you are interested as well in different markets. So this is the short sterling. Similar here, we went from very little expectation for the Bank of England to do something until the end of the year, a move of 10 bips. So that was the move of 10 bips. So suddenly we went from 10 bips to 40 bips, 50 bips. So now market participants are very much expecting as well the Bank of England to be hiking rates. And if you do the same with the ECB, which is going to come on stage next Thursday, there has been hiking expectations. So bottom line is, over since the start of the month, last 2 to 3 weeks, really expectations that central banks will be much more hawkish in 2022 onwards. So market is starting to price inflation to be less transitory and to be there for longer. Now the risk is, if on the other hand we think that the economy could slow, and or that the central banks could be damaging this growth going forward, that could be an issue for the overall market. So that is for the macro. That is for the Bank of England expectations here. As you can see, this is a similar move where the move has been pretty significant recently. That is very true for that period of a year or two, where the market is expecting inflation to pick up due to the world reopening. So if it is not transitory, this inflation, and we discussed that over and over, that's going to have some implication, the potentially margin compression. So far, many companies have been able to pass the prices hike. So that is true for companies like Nestlé, like L'Oréal in Europe, Danone, because we had Unilever today. But what they are telling you is, in the next 6 to 12 months, they're going to be hiking rates. They're going to be hiking prices. So we, as consumer, will see CPI. So there's going to be CPI, PCE higher. It's going to be staying here. And that means we get the second round effect of inflation. So the question now, when we do ID generation, and this is not always an easy task, is when I'm looking at a company, what is the pricing power of the company? Okay, pricing power, in other words, is the company a price maker or is it price taker? And what is his ability to pass on cost to the consumer, and to which level you can do it, and pass it to the consumer. As I just said, companies like L'Oréal have been able to do it. Nestlé has been doing it better than Danone. So this is purely for food consumption, but you can do that for most sectors of the industry if there is a chance that cost will be running higher. So earnings season. So this one is the same slide that I used from a couple of weeks ago, where the earnings were expected to grow up by 29%. 22% ex energy. But the important numbers were by how much companies are beating expectation on both the top line, which is for the revenues, and on the bottom line, which is EPS. So recently, companies have been doing pretty good over the last 4 quarters, as we're going to see later in the slide, to be beating expectations. So this slide is from JP Morgan, and I think this is pretty interesting, where we get the US and European quarterly EPS and the global composite PMI. And what JP Morgan is telling us is that the weekly EPS revisions in the US have been turning negative for the first time since the summer 2000, where we've seen weaknesses in discretionary, financials, industrials, and materials. So that's something that we discussed a couple of weeks ago, but that goes hand in hand with the slowdown of the different PMIs. World PMIs and the regional PMIs, and but that is very unusual to see that on a half year to a half year, where you see these expectations lower from H1 to H2. So what you have is the market has been pricing an earnings season not as strong as before. Now we need to check how the companies have been doing so far in terms of beating expectations. So here's a similar chart where we get the S&P 500 positive to negative revisions. As you see, since the summer, we have been coming down. So we know for a fact that for the S&P to grow most of the time, it is a question of the earnings growing. So here, this is from Bloomberg, where we look at how companies so far from the S&P 500. So this is the 500 companies of the S&P. So far, 90 companies have been releasing their data. Out of them, 60 out of 90 have been beating expectations for the top line, for the sales. So that makes 66%. And for the earnings, 73 out of 90, which makes you 81%. So let's look at facts. So in Q2 2021, we had 87.4% beat on sales. And in Q1 2021, we had 78.5 beat on sales. So far, and really so far, because that is only roughly 1/5 of the S&P 500. The top line beat have been lower than the previous 2 quarters. So I see many tweets of people telling us, earnings have been incredible, top line have been incredible. Actually, top line, we've seen beat, but the beat have not been as strong as they were a couple of quarters ago, last couple of quarters. And in terms of bottom line, 80% is very much something that we had recently. So here, this is the historical EPS beat. So this one is from Dow Jones. When we look at the quarter, last quarter, 82%, Q2 2021, 86, 85, 76. So the numbers over the last couple of years have been around 75, 80%. So when you come with 81%, it's not that it's bad. It's a very good number, but don't be surprised. It goes hand in hand with what happened before. And I would like quickly to look at some chart. So let me write down JP Morgan, DAL, and UNH, where I want to show you quickly how the market and the companies that have been coming with earnings have been not doing versus the market. So as I said, market is very much driven by earnings. JP Morgan came with their earnings last week. So here, this is a chart of JP Morgan versus the S&P. And you can see that JP Morgan has been flattish versus the S&P over the last, since its earnings. So in other words, if you look at the leaders, they are not be doing much better than the overall market. So I don't think that this market is telling us, oh, these earnings have been so good. Look, this company, JP Morgan, is up 5% because it got good earnings. It's just, everything has been going up. If you look at DAL, another example versus the SPY, it has not really outperforming the market. Okay, if we look at another one that came with good earnings, which was UNH. It has been a bit of outperforming, but look at the last 3 months, it's in the same trading range. So to me, the excitement that we have now around the earnings, I can understand for the bottom line, which is 80%. The top line, I think, is a problem and could become a problem, especially how we are coming from a very high level. So I don't think that this earnings season is not as bullish as the other ones, and to me that requires a bit of cautiousness going forward, especially as we are making a all-time high. Make no mistake, again, a couple of weeks ago, everyone was telling you to be cautious. We're going to go lower, and now we are 5% higher and testing the all-time high, and now everyone is telling you to go long. So based on numbers, earnings, it's an okay season, but it's not like crazy over good season. Okay, earnings calendar, as I discussed, as we are in the middle of the earnings season, go to on different website. I always use Earnings Whisper just to give you some indication. Why? Because next week will be really crazy busy. We get Facebook Monday after the close, Apple on Thursday after market, and Microsoft on the 26th after the close. So here, this is an example with one specific day. So that is for the 26th, so that is for Tuesday. You can see many names. The list is just huge. So if you get positions, obviously check when your company will be coming with earnings, but as well, try to find any competitors, leaders from the industry or the sectors that will be coming with earnings. So Earnings Whisper, there are tons of websites. You can go on investing.com or others, but do that. So a bit of oil market. We were talking a lot during the first webinars that I started to do last year around March, when oil started to go negative. So here, this is the oil curve. So this is with the future contracts. So we go from November here up from November of this year to October next year. And as you can see, the spot prices, the prices that we have now are above the prices in the futures. So in other words, oil is in the backwardation, meaning that spot is higher than future prices. Why is it the case? Because we know that the world is desperate to get some oil, that there is some storage level issues. So if you look at the US, there has been concern, and JP Morgan raised the issue recently that the US, I think that is the Oklahoma storage, only got 20%. So meaning that if demand is picking up, everything will be dry. And if you remember last year, when the oil went from positive to negative, is because there was literally no place to park or to store your oil. So if you were buying the contract last year when it went from 20 to minus 50, even if you were buying at $1, there was no place in the US, Oklahoma, to park your oil, because literally every reserve in the US were full. Whereas now you get a 20% full capacity, meaning that if oil is, if the demand is going higher, then you could have a problem for the next couple of months or 3 months. So, and if you look at this curve, you see here that prices then are pretty tight, at least until Feb next year. And then there is a bit of cool down in this tightness. And that tells you about the next 3 to 5 months, how the tight the oil market is. That is even more true. Why? Because the price of gas across the world has been spiking. That is very true in Europe, but not gas as well in the US. So if you look at Europe, the price of gas that is not coming from me, I'm not smart enough, that is the equivalent of $200 of WTI. So if you are running a gas plant, suddenly you are switching your gas into WTI or oil, as long as you have the other technology. And that means suddenly the demand for oil for the next 3 months, 5 months is going up, because we are switching from oil to gas, and that adds between 500,000 oil barrels more to 1 million barrels. So if you look at the correlation of the oil consumption versus the world GDP, there is obviously a massive correlation. So here, this is a chart where we have in blue the world oil demand year-on-year change, and in brown the world GDP growth. And I've been using the expectation for next year from the IMF. So this is the part for next year, where we are expecting the IMF is expecting the world to grow by 4 to 5%. I think it's 4.4%. So as long as we think that obviously the world is growing, oil demand will be going higher. So that tells you to look at for the oil market, this is mostly like any commodity, a question of supply and demand. Okay, so this chart, I've been working on it on Monday, where in blue we get the total world supply, in yellow we get the total world consumption, and at the bottom, which is going to be on the right hand side, we get the surplus and the deficit. Okay, so if we look at last year, we see in yellow the world consumption just went down the toilet. Sorry for my English. And in the meantime, what happened is in green, we got a massive surplus of 20 million barrels. Okay, so that was in March, April last year. Then the consumption, the world consumption starts to pick up, to go up again. And in the meantime, some supply capacities were lowered, and as well the OPEC decided to reduce production. Okay, so you go from a very big red surplus to negative. So here, this is all the negative months that we had since then, meaning the world is using or is consuming more oil than it is producing. So if you take a bit of step back, what happens for oil, for the oil sector, and that's something that we discussed literally more than a year and a half ago, when an oil major decides to go from one project, it takes literally 12 to 18 months. Okay, so if Total, if Royal Dutch Shell, if Chevron decides to go for production, in terms of capex, between the moment they decide and the moment it goes into production, it takes 12 to 18 months. So what happened is between March last year to probably March this year, all the majors said, we're not going to do much. Okay, so for the production to start to pick up, it's going to be taking some time. It's going to be probably going to have to be in 2022. Or at the end of 2022. And that's the same with the US production, where all the shale get absolutely hammered when oil was at below 40, 45, because the average or the average cost is around 45, 50. Now, what you're going to see is the US production is going to pick up. Okay, with oil at above 80, you get a huge incentive for people in Texas to start the production again. So in terms of surplus and deficit, so this is the chart. Here you get the huge surplus due to the world literally stopping, everyone staying at home. So you went from 100 billion barrels consumed every day to roughly 80 million every day. Okay, so that gives you a 20 million barrels difference. And then from July 2020, we start to see a deficit, a deficit. Oh, I'm struggling here. Deficit running. Okay, so this is what happened so far. So now we are here. This is where we are. And guess what we have here? So this is the next slide, hopefully, if I did the job. Yeah, so this is the next slide. So this is from surplus deficit expectations, okay? Everything is expectations and you need to take it, but that is from the IEA. From next year, around March, April, we start to see a surplus. And that's the same if you look before at what we did with the oil contango backwardation. We've seen that the contracts start really to come down from at the end of Q1 2022. So in other words, if we try to survive the next 3 to 5 months based on less production, problem with gas from Russia, nat gas issues in the US, oil, there is a good potential that oil will come down again. So my view is the following, it's a bit contrarian. I think that everyone and his mother is now saying that oil should go higher and higher and higher. So on Twitter, everyone is long the oil. On social media, everyone is long the oil. And I think if you look at the fundamentals, I don't think that the economy, the world economy, will be firing on all cylinders next year. So thinking that we're going to have 4 to 5% is pretty much aggressive. So if you have more than 4 to 5%, that means you're going to need less demand. I think the US will be producing more. And I think as well, the next 3 to 5 months, the gas issue will come down a bit. So my view is oil, and that started to do the work over the last 10 days with oil at 83, 84. I think it's going to be, you could have in your face a short squeeze into the 100 because there is still this call for many to say 100. But fundamentally, and again, I might be very wrong, if I look at supply and demand, I think there is a good call for oil to come down now. That is a risky call. But I will say, I did the opposite 18 months ago. Now it feels to me like if we survive these next couple of months, the price of oil should come down. Okay. So quickly going through what we can do together. So trading community. So it's something that I'm pushing today. Push for an ID. Push for a nice ID with, so we look at TUI, which had a rights issue that ended up this morning. The stock rallied 7% on the day after the rights issue. So I try to explain those things to the community. Everyone is sharing IDs from tools to long IDs, short IDs. That takes time. I'm very bullish on this community. I like it very much. Something that I enjoy. Second product that I do, the 4x4 video series investment process. I build this video series based on my 20 years experience and as well on my experience as a mentor where I've seen people struggling. And the mentoring is one-on-one sessions, Zoom or Skype, where over 3 to 5 months, we work together on building your watch list, your infrastructure, generating ideas, understanding the market. I've had a lot of demand recently. I don't know why. There's a bit of cyclicality. So it's pretty packed going into next year. A couple of days ago, I had someone who, that was quite funny, called me and said, look, Greg, I've done another mentoring. I've been struggling. I've been told to do only options. I've been told to do, I think it was calendar spreads. But literally I ended up the mentoring program and I didn't understand anything that I was supposed to do. So literally for me, my style is is literally to get an investment process and to understand what you're doing. So maybe we are not the best at what we do. Maybe we don't have the most fancy things. But if we don't understand what we do, buying or selling, we should not be doing. So hopefully, normally, when you do the mentoring, when you get access to the community, that should help you. So this is it for today. So I'm running a bit of a short on the S&P. It feels to me like it's not going to be working as usual. Otherwise, the market really bounced nicely by 5%. I don't think this earnings season is that crazy good. EPS are better, but top line is not that better. I mean, it's 60%, which is on average versus historical standard, not that good. So next week is going to be telling a lot. Obviously, again, cyclicality should help, but there are a lot of negatives that I could see as well, which are central bank's expectation, where we went from very dovish to now literally central banks will have to be hiking rates. So I think that could be a negative. And that should be a negative. Oil is still very high. We see the second effect of inflation. If you look at the US, it seems like everything is on the standstill. The Biden administration is just losing traction, and we get election next year in the US. So I think uncertainty will come back again, especially if they don't manage to pass a deal. So to me, there are many questions that are not answered. The market is just driven by options frenzy. Today we had this SPAC that went through the roof. But other than that, I have to say, I'm talking my book, so I'm biased. But 5% lower. I told you that I didn't see that much downside. Now I'm a bit struggling. Any question that you have, you reach me, email, or on Twitter or whatever, if you get questions. And we try to do the same in a couple of weeks. As always, interesting season coming, earnings season, a lot is probably going to happen. And see you in a couple of weeks. Thank you, everyone. Thank you for joining. All the best. Bye-bye.